Today, we're diving into a heated debate happening on Wall Street. Industry giant Ken Griffin, CEO of Citadel, is taking aim at the SEC Securities and Exchange Commission recent regulatory proposals, particularly those concerning climate disclosures. Let's unpack Griffin arguments and explore the potential consequences. Hello, everyone. Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But before that, alert: this is not a financial advice video. Griffin argues that the SEC new rules lack a crucial element: measurability. He questions how effectively companies can track and report their environmental impact, particularly regarding greenhouse gas emissions. His point is that without accurate measurement, these regulations become a burden with little actual benefit. Griffin suggests a different approach, tackling carbon emissions at the source through a carbon tax. This, he argues, would incentivize companies to reduce their environmental footprint more directly. Griffin warns of unintended consequences from the SEC proposals. He fears a decrease in companies going public, leading to fewer investment opportunities and a decline in venture capital formation. This, in turn, could stifle research and development, especially in the tech sector, where many VC-backed companies are at the forefront of innovation. The video then poses a critical question: is Griffin simply trying to deflect attention from Wall Street itself? The implication is that the proposed regulations might hold investment firms accountable for the environmental impact of the companies they invest in. By focusing on measurement hurdles, Griffin might be trying to shift the focus away from Wall Street's role in the climate crisis. The video uses an analogy to illustrate the challenge of unmeasurable impact. Imagine driving without a speedometer and getting pulled over for speeding. You can't argue your innocence because you have no way to measure your speed. Similarly, without clear metrics for environmental impact, holding companies accountable becomes difficult. The question then becomes, who has the burden of proof? Should companies be held responsible for their environmental footprint without a perfect measurement system? Or should the onus be on regulators to develop a more robust system before implementing such regulations? Griffin suggests that the SEC would need to create a whole new system to track emissions and assess penalties, further inflating the cost of compliance for companies. This cost, he argues, could ultimately be passed down to investors and consumers. The video raises the point that investors themselves might be interested in a company's environmental impact. Shouldn't they have access to clear data to make informed investment decisions? The video speculates that Griffin might be frustrated with the SEC's lack of receptiveness to his arguments. Perhaps he's not used to having his viewpoints challenged, leading to a sense of frustration. Conclusion: the debate between Wall Street and the SEC regarding climate action regulations is complex. While Griffin raises valid concerns about measurement and unintended consequences, the video also highlights the importance of holding corporations accountable for their environmental impact. Finding a balance between effective regulation and practical implementation remains a critical challenge. What are your thoughts on this debate? Do you think the SEC proposals are the right approach? Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.